Hello, everyone. My name is Robin Dolezal. Today is Wednesday, September 22nd. With me, as always, is Dan Nintel and Alex Pars. Together, we are with Ironwood Financial. How are you, gentlemen?
Good. How are you?
Doing very well. Can you believe it? Today is we are 265 days into the year.
It's fall today, right?
First day of fall.
72% into the year. We got 100 days left. It's crazy.
Nice.
No,
And it's
no more
only going to be
rain.
97.
I know. I was hoping for cooler weather, and as I looked, it got a little cooler in the next like 3 or 4 days, and it jumps back up to mid-90s. So
I was, in fact, when we were at that foundation for the last week, Robin, I was talking to somebody, and they said, I said, well, it's supposed to cool down, and he's like, "Who are you kidding? It doesn't cool down until Thanksgiving." I was like, "Oh, that's kind of true."
it's true. I want to say like 8 years ago, we were doing Halloween. I was like, "Oh, this is nice. It's nice and cool," and it has not. And we have not had a cool Halloween in the last 7 or 8 years. It's crazy.
Yep.
Anyway, it's been a while since we did one of these. I want to say a lot's happened since then. We've Daniel, you lost Ellie off to school out of state.
Yeah.
We had David Renzi, our own colleague and friend, just got married as well. What else has gone on? And the kids are back to school. I think the kids, that was a new thing since our last deal.
Could be.
Could be.
Anyway, it's good to see you guys. A lot's been going on. Seems like the market's still up since we did this last, but obviously the last couple of weeks has been a little rocky. So let's start with just the market. What's going on in the market, Dano?
Actually, the market, and actually, if you got up bright and early, or if you live on the East Coast at normal times and got up and looked at the futures, Wall Street kind of had this idea that the Fed wasn't going to really do anything. They weren't going to change their guidance. They weren't going to taper or raise interest rates or lessen the amount that they're stimulating the economy. And the futures were up really nicely this morning, and it ended that way. Every indice pretty much was up about 1%. The large caps, technology, mid caps and small caps are actually up about 1.5%. So that was kind of nice because they've been lagging this year. But even it's kind of funny, you had dividend stocks go up about 1% as well. So the entire market was pretty pleased with the idea that Jerome Powell is not going to mess with or change any form of the quantitative easing. In fact, he raised his guidance saying that inflation is probably closer to 4%, which normally would say they do want to raise interest rates, but he said the economy is still not ready yet, and they're not going to do anything until 2023. And even then, it'll be maybe a couple quarter percent interest rate increases. So Wall Street's pretty happy. And let's be honest, it's kind of how September has gone. And if you look at history, it's kind of how Septembers go. September historically is the most volatile month. Second and third quarter are usually where you get the least amount of your return. Fourth quarter is historically where you get the most of your return. So we're seeing volatility, and it's rightfully so. I mean, we're worried about, fourth quarter. We're worried about, there are two really big things. The market doesn't care about COVID anymore. The market doesn't care about Afghanistan. They didn't care about the real estate debacle in China. Wall Street cares about what the Fed says. There is some concern about, you hear it on the news about the raising of the debt ceiling, but let's be honest, I think, Alex, I should have you talk about that, but they're not going to go in a situation where they let the dollar default by not raising the debt ceiling. So that's kind of a silly thing to worry about, but it's obviously in the news. But reality is, even as volatile and as depressing as Monday was, we were never more than 3% away from all-time highs. Mm-hmm. So, I've had a lot of people calling in with angst of, I'm worried about this, and rightfully so. I'm worried about that, and also rightfully so. There's a lot of concerning things in the world. But the capitalism of Wall Street doesn't seem to worry about that. And we've never veered much from all-time highs. In fact, as we speak right now, we're less than 2% away from our all-time highs in the market. So market seems pretty happy about what the Fed's doing, stimulating the economy.
It's always healthy for the market just to take a breath every once in a while, right?
Yeah. And
we
statistically, it should. Yeah. I don't know what you're talking about, Robin. That's a silly comment. Statistically, it should give us a breather once every 4 years. It's just, you have to realize that statistic was coined pre-2008. And in 2008, when we had the great financial crisis and the heroic measures done by the Fed and actually the government at that point to kind of bail out some companies that could have, through contagion, taken the dollar down, realized we learned that we could quantitative ease or print our way out of it. And since that point, we haven't had the down market once every 4 years because we have now learned, and as long as the world allows us to do so, to stimulate the economy, to pull ourselves out of what could be horrific events going on. I mean, the pandemic should have shut down the entire world and shut down the economy, and should have been just devastating to our portfolios. However, the Fed knows how to pull itself out. So the questions that I'd like to have Alex talk about, and I don't mean to put questions into your mouth, Robin, but can we do that forever, Alex? I mean, can we continue just as print?
So far, yes. I mean, that's kind of the fun part about this whole quantitative easing thing, which is there's been no negative repercussions. Whatever we print more money, the dollar gets stronger.
Mhm. Yeah.
So it's totally counterintuitive, but people across the globe just say, hey, look, they know what they're doing, and we're riding along with them. So that's what's been happening so far. I mean, I think as long as we pay lip service to being responsible in terms of money creation, they'll believe us.
Mhm.
And it's worked wonderfully. I mean, to put it in perspective, we're doing 50% more QE now than we were doing at the height of the financial crisis. And at that time, we had 10% unemployment with jobs that weren't coming back. People couldn't find any, employers. Now we've got 11 million unfilled jobs in this country and only 3 million people unemployed. So even if every one of those people were employed, we'd still have 8 million unfilled jobs. So that's a very different picture in terms of the economic strength that we've got going on. And yet still, we've got basically no inflation. And the Fed says, sure, let's keep printing.
Mhm. So
good for them.
so we had the Fed met yesterday and today, right? So
Yep.
what did they in fact say by the end of that meeting?
And this is something that's very frustrating every time a Fed meeting comes up, which is there's lots of speculation. Oh, is the Fed going to change their tune? Are they going to do something different from what they said they were going to do? No, they're not. The Fed's going to do what the Fed said they're going to do. That's how they operate. Okay, so they've been telling us for over a year, no rate hikes until the latter half of 2023. What'd they say today? No rate hikes till the latter half of 2023. What a surprise.
Yeah.
So
We're expecting a couple by next year, and what did I hear? 6 to 7 by the time we reach the end of 24.
yeah, maybe. But I mean, they're going to keep interest rates low for a prolonged period of time. And again, something that people forgot last time, which was, oh my gosh, as soon as they start raising rates, the stock market freaked out. Why? Because if you raise interest rates, suddenly I've got an alternative where I can put safe money that's going to earn something. I'm sick of earning, someone I know just bought 3-year CD at 0.6%.
Ooh.
Yeah, inflation's 4 this year, right? Is that a good
Yeah.
idea? No, that's not a good idea. They expect inflation to be over 2 next year. So you're guaranteeing a loss on your money there if you buy that 0.6 CD. So what do? You don't buy that CD, you put your money in the market. Well, guess what? If they raise that from 0.6 to 1, are you going to jump out and buy that CD? No, you're not. So even once they start tapering, once they start raising interest rates, the first couple of years aren't going to be a major threat to the market anyway, because they're not going to go and say, all right, we're at 0.6 today. Next month CDs are going to be 6. It's not going to work that way. It's going to be, we're going to raise by a quarter point, see how things goes. We're going to raise by half a point, see how things go. It may take a year to raise a point, and then, another year to raise another point, and so on and so forth. So we're going to be in this stimulative, easy money economy for probably the next 5 years, if not longer. And I mean, it's going to be a long time with 4% inflation, Robin or Dan. What do you want to get on a CD before you're interested?
Well,
6, 7? I mean,
right.
after taxes, that's a break even. So
And I don't even think, I think and I know this is supposed to be transitory, but I think I just read that 12-month trailing inflation was 5.3 by the end of last month, August.
yeah, they're saying for the year of 2021, they expect 4.2. And the
Okay.
year of 2022, they expect 2.2, but they expected 3 for this year. So that with the supply chain shortages, which are still going on, I could see that's being extended and going up next year. I'd be actually frankly surprised if it didn't,
Mhm.
that estimate.
You know, what's interesting story is that the supply chain shortage, especially with all the chips, because all these car companies have all these cars on the sidelines waiting. But what's also interesting is all of these car companies are also trying to do this huge revamp of switching over to electric. So it seems like once you do that, you're going to even need more chips. It just seems like it's just compounding on itself.
Yeah, this is something we expected to be gone by roughly now.
Yep.
And now I'm reading that it's likely to be around for another year and a half.
Mm-hmm.
So that also will help mask the inflation question, because you got items like cars selling for, MSRP, which normally doesn't happen. And that's going to, as long as there's these shortages, it's going to look like inflation. So it's going to be really hard to separate those two pieces out.
Alex,
So-
I just want to confirm, did Dan guarantee a fourth quarter victory for us?
Yeah, I'm pretty sure that's what I heard. Honestly, here's the thing. The thing on Monday with that Chinese real estate company, which turned out to probably be nothing, okay, just like the European debt crisis turned out to be nothing. I mean, this is even smaller and it's a company. I mean, company goes out and we're going to have global contagion. I just don't see it. So even if that were a big deal and the market freaked out, what would be the policy response? The policy response would be, okay, you better bet that $3.5 trillion bill is signed in a week or two. And then the Fed's turning on all the afterburners again. So it's very, very difficult in my mind with what's going on in the world right now to see the market fall, because the market and real estate is what's driving this economic recovery. So the politicians really can't afford to let it go down.
Mm-hmm.
So we start to see negativity. I expect them to turn the spigot back on or turn it up and boost us right back out of it. That's my speculation, but that's the way I see it. It's still too fragile of a recovery, which has been driven by stimulus and by the markets to allow that to be risked at this point.
Yeah.
And something to keep in mind, and let's take that, pivot that, and focus that based on how we're managing portfolios. I've received probably more in the last couple of weeks, emails, comments, people calling out concerning, with the world, the political divide, Afghanistan, debt ceiling. A lot of people have said, well, how are we going to make sure or protect, or what's our strategy to pivot out of equities? And reality is, at this point, if you look at what Goldman Sachs put out this morning, their idea is not how are we going to protect, it's how, when we get a dip, it's time to buy.
Absolutely.
Buy on dips.
Until interest rates go up, unless something totally comes out of left field, it's $120 billion a month they're putting into this.
Right. So you pivot that to Ironwood. We have allowed our portfolios to get more aggressive than historically we've allowed, for the simple reason that bonds really aren't paying. I mean, the reason you used to buy bonds is as a safety hedge against the stock market. Well, that hasn't worked anymore, because they're only paying, if you go out 4 or 5 years, you're getting a blended yield between quality and junk of maybe 3 or 2.5%. So we've let our portfolios grow a little bit, and that is the strategy we're anticipating throughout the rest of this year. And of course, if policy changes, that'll change our strategy. And of course, we'll relook at that, at every investment policy meeting we have. But for those of you out there wondering, our strategy is not to sell equities at this point, is to flow with the Fed and continue to buy on dips when we see an opportunity.
Yeah, and there are little shifts between different sectors that do better or worse depending on what's going on in the world, but it's all about the Fed. Broken record. The Fed, the Fed, the Fed,
All
the
about
Fed.
the Fed.
Probably for the next 5 years.
Alex is Alex's like little saying for the year, all about the Fed. What's going on? All about the Fed.
Yep.
We're just gonna have a cardboard picture of Alex.
I appreciate your time today. I look forward to doing this again, folks. If you're watching, and obviously we didn't do this live today, this is recorded. So if you have any questions, please don't hesitate to reach out to us, and we will answer those questions directly with you, or else we can address those at the next video. And if you are not a client of ours and you'd like to reach us for bouncing ideas, you got questions, you can reach us at 888-271-4646, or of course our website, ironwoodfinancial.com. Guys, have a great afternoon. We'll see you next time.
All right, take care.